Hi guys. Thank you once again for coming online. Well, last week, about 2 weeks ago, in fact, we were covering time value of money. Right. So, any questions up to now? If I can quickly do a quick recap. By the way, I hope you all can hear me. Okay. Right. Yeah, we want this. Right. So the two equations we came across are present value is the future value for 1 plus r to the power n, right? That's where we stopped last week. Also, future value is the present value into 1 plus r to the power n. Yeah. Any questions on this? Right. So if there are no questions, let's move on. We calculated present values, discounted cash flows. We did the examples. And I think this is where we stopped. Right. We have to do annuities. Am I right? Okay. So annuities. Okay. So what is an annuity? It's something like this. You initially place a deposit of, let's say, 100. Right. You deposit 100. Then every year, it gives you a cash flow of, let us say, 10. Every year, cash flow of 10. Right. So the amount you receive every year is the same. Annually, you get the same amount. That's called an annuity. Now, if this is the case, you can calculate the present value of this annuity or the future value based on these formulas. An ordinary annuity has a regular periodic payment that occurs at the end of each period. And so this equation gives the present value of an annuity. Now the good news is you need not memorize this equation, right? I have tried so many times to memorize this. Very difficult. You don't have to memorize, it will be given at the exam, but you need to understand the concept. How can you calculate? Right. Now, basically the future value of an annuity is the payment that you get annually into 1 plus the interest rate minus 1 divided by the interest rate. Right. So that's how we calculate the future value of an annuity. Shall we try this example? It is an annual payment of 100 invested at rate of 5% for over a period of 3 years. What is the future value of this annuity? Right, you need to use this equation. Then the cash flows you get, every year you get cash flow of 100. Interest rate is 5%. And now the peak number of periods is 3. Okay. So the future value of this annuity is the annual payment into annual payment is 100, 1 plus 5%, 3 minus 1 divided by 5%. 315.25. Okay, so hope all of you got the answer. Okay. Any questions? The next one. On to the next. Present value of an annuity. Given by the equation shown here, which is an annual payment 1 divided by interest rates minus 1 over interest rate into 1 plus interest rate to the power n. Okay, so the question is the present value of an ordinary annuity is the sum of the present values of individual cash flows, right? You take each in every individual cash flow and get the annuity, get the present value, and total it up, you get the present value of all annuities. So it's the reverse of what we just did. Let's calculate the present value of this annuity. Again, you don't have to memorize this equation. These are payments. 100 into 1 over I is 5% minus 1 over 5% to the power 3. So you end up with 272.30. It's the present value of this annuity. Yeah. So any questions? No questions. Let's move on. To the practice questions. Right. So let's try question number 1. Assume that you plan to buy a condo 5 years from now, and you estimate that you can save $2,500 per year. You plan to deposit the money in a bank that pays 4% interest, and you will make the first deposit at the end of the year. How much will you have after 5 years? Okay, so let's try this. You're buying a condo 5 years from now. You're going to save $2,500 every year. Payment for the next 5 years. Interest is 4%. You're making the first deposit at the end of the year. How much will you have after 5 years? Right? How much will you have after 5 years? Which means at this point, how much will you have? Right? So that's the future value. And if you look at the cash flows, you're receiving the same amount every year for 5 years. So it's an annuity. You need to calculate the future value of this annuity, which is get 13,540 bucks. Okay, so any questions up to now? Let's move on to question number 2. For an ordinary annuity with 5 annual payments of 100 and 10% interest rate, how many years will the first payment earn interest, and what will this payment's value be at the end? So it's a pretty similar question. Five annual payments of $100 each. Right? Every year you pay 100. Interest rate of 10%. How many years will the first payment earn interest? Right. So the first payment which you make at the end of the first year will earn interest once, twice, 3 times, and 4 times. Right, so the answer is 4 times. And what will this payment's value be at the end? Right. So you need to calculate the future value. Once again, the future value. Using the same formula, future value will be $100 annual payment, 1 plus interest rate of 10%. N is 5, power 5 minus 1 over 10%. The future value of this annuity is $610.51. Question is, how many years will the first payment earn interest, and what will the payment's value be at the end? Okay, so the question is, the first payment will earn interest 4 times. What will be the value at the end? Right. So what is the value of this $100 only? Future value is present value into 1 plus r to the power n. Present value is 100, 1 plus r is 10%. It earns interest 4 times. 146 cents 41. So question number 3. Any questions? Okay, question number 3. Assume that you are offered an annuity that pays $100 at the end of each year for 10 years. You could earn 8% on your money in other investments with equal risk. What is the most you should pay for an annuity? So it's something like this which continues for 10 years. Payment is 100 annually for 10 years. 8% you earn. Number of years is 10. So now this means you are supposed to make a payment today and it will give you a return of 8% over a period of 10 years. Right? And based on these figures, the numbers, the interest rate of 8 and number of years 10, every year for the next 10 years you get a payment of 100. Right? So you're getting 100 every year for the next 10 years. Question is, what is the most you should pay for the investment, for the annuity? So how much should you invest today to earn these returns? Right? It's a present value question. How much you should invest today is a present value question. What is the present value? You can also find the future value of this if you want. Right? Present value based on this formula. You need to invest $671. Okay, so those are annuities. Next one is a perpetuity, right? Perpetuity is something like this. In this previous example, the $100 you received only for 10 years. But perpetuity is where you receive it, the same amount, indefinite. Right? Eternally you receive the same amount. That's called a perpetuity. Not only for 10 years, but it goes beyond that. To the foreseeable future. It's called a perpetuity. Equation to find, remember you can only find the present value of a perpetuity. Present value. You can never find the future value of a perpetuity because it does not end. Right? So calculating present value of a perpetuity is very simple. I will in fact use the present value of an annuity formula and show you how you arrive at the present value of a perpetuity. Present value of an annuity is the payment times 1 over interest rate minus the power n, right? So when it comes to a perpetuity, n it becomes infinite. If you rewrite this, present value is the payment 1 over interest rate minus 1 over interest rate into 1 plus interest rate power infinity. Right? Now 1 over 1 plus interest rate into infinity to the power infinity becomes infinite. It's a 1 over infinite is the entire term is 0. Meaning you end up with present payment into, I'll write it underneath, sorry. This is the payment into 1 over interest rate minus 0, which is payment into 1 over interest rate. That is equal to payment divided by the interest rate. So remember, the present value of a perpetuity is the payment divided by the discount rate. Very simple. This you need to remember. Payment divided by interest rate, you need to memorize this. Very simple, easy to remember. So let's try this question. Perpetuities are securities that promise to make payments forever. The present value of perpetuity can be found with a simple formula 1 over R. Note that we cannot calculate the future value of perpetuity because payments go on forever. This value would be indefinitely large and meaningless. A British console that pays $25 annual payments. If interest rates are currently at 5.2%, what is the value of this console? Very simple. The present value is future value divided by the interest rate. Sorry, is that what am I saying? It's the payment divided by interest rate, where the payment is 25 and the interest rate 5.2%. So the present value comes to 480.77. Right. So any questions? Any questions on this? Okay. Let's move on to the practice questions. Let's try the question, first one. The US Treasury offers to sell a bond for 585 since 43. No payment will be made until the bond matures in 10 years from now, at which time you will buy it will be redeemed for $1,000. What interest rate would you earn if you bought this bond for 585.43? So let's draw the diagram. It's always easier if you can draw a timeline. Present value. You're buying it today for 585.43. One matures in 10 years. You will be redeemed $1,000. Question is, what is the return? Present value 585.43, future value is 1000. 1 plus the interest rate is what you need to find. N is 10. So the interest rate is 1000 divided by 585.43, right? So I have cross multiplied. So 1 plus interest rate to the power 10. 1 plus interest rate. The 10th root, meaning the interest rate is 5.5%. Your return will be 5.5%. Question number 2. Microsoft earned 12 cents per share in 1994. So earnings per share was 12 cents in 1994. 10 years later, in 2004, it earned 1.04. What was the growth rate in Microsoft's earnings per share over the 10-year period? Microsoft earned 12 cents per share in 1994. 10 years later, so N is 10. It earned 1.04, future value 1.04. What was the growth rate? Present value, future value for 1 plus R N. you should get 24.1%. And that was a very similar question, the first one. Any questions? And question number 3. Microsoft's 2004 earnings was 1.04 and growth rate during the prior 10 years was 24.1. If the growth rate were maintained, how long would it take for the EPS to double? Two 2004 earnings 1.04, growth rate 24.1 will be maintained. How long will it take for EPS to double? Meaning from 1.04 to go to 2.08 doubles. How long? The question is how long does it take? Right? It's again present value. Always write the formula. Don't forget to write the formula to the power n. Present value is 1.04. Future value is 2.08 divided by 1 plus 24.1 into the power n. Plus 24.1 power n is 2.08 divided by 1.04. This is 2. It is doubling. So 1.241 to the power n is 2. Then you need to take the logarithms in 0.241 equals the logarithm of 2. So n is the logarithm of 2 over the logarithm of 1.241. $3.21 years. They will only take 3.21 years to double. Any questions? Question number 4. What is the present value of perpetuity that pays $1,000 per year beginning 1 year from now, and if the appropriate interest rate is 5%? Payment is $1,000 beginning 1 year from now, and the interest rate 5%. The present value is the payment divided by the interest rate, 1,000 divided by 5%. $20,000. Okay. Now, what does this $20,000 mean? It means getting $1,000 a year, right, into eternity is equivalent to getting $20,000 today. Right? So, if you keep getting $1,000 every year into an infinite period of time, it's as good as getting to $20,000 today. Okay. So, any questions up to now? No questions? Yeah, so that's basically about time value of money. Right. So I think next week you all are having exams. Okay, so we have only 3 in this class: Jayani, Narmila, and Vasana. Sort of amongst the 3 of you, are you all doing exams next week? Yeah, we also have Malaka. Right. So are all of you taking exams next week or no exams next week? You all are doing exams next week. Okay. Right. So all 4 taking exams. Any questions you need to ask? You can unmute yourself and ask. No need to type. Do you have any questions before you go for the exam next week? Or did you all come online for the revision? Were you all there at the revision? Which I did about 2 weeks ago. Right. Well, there was a series of revision classes which was conducted by IBSL. I think the recording is probably online. So you have to talk to the institute and get the recording from them. So any questions you have before you go for the exam? Because this is the last week we are meeting before the exam. Next week, by this time, you all would have completed financial management and hopefully passed it also. Okay. Right, I understood. So none of you are doing financial management, right? Any one of you doing financial management? Malaka is doing. Jayan is not doing. Vasana and Narmala are also doing. How about Randima? Randima, are you also doing financial management this year?
Yes.
Oh, okay, so you are probably Randima and not Randima. Sorry about that. All right, so except Jayani, all the others are doing. Any questions you might have? I can maybe spare a few minutes for questions. Okay, so if no questions, I will move on to the next area, which also means now, technically next week I should only meet Jayani, right? Because she's the only one who is not doing financial management this time. The rest of you are doing financial management. So hopefully I will not see you next week, right? You should, all four of you should pass. Just make sure you don't come back for financial management and make sure you complete it. Right? Next Saturday should be the last day. All four of you are doing financial management. Don't even think about doing it again. Now you have 1 week, one full week to study. So my advice is you take all the leave you have, use your casual leave, your annual leave, or your maternity leave if you want. Whatever the leave you have, you take and you study. Right? Financial management, very easy subject. Just about getting the answering skills right. Yes, Vasana. So this is all the more reason for you to finish this subject. Don't keep it pending, and make sure you don't repeat it again. Right. So I hope this will be the last time you're doing it. Anything you want to clarify before we move on? Okay, so let's move on to the next area. It's on business valuation. Right, valuing a business. Now, typically, before you give a loan, maybe a housing loan or a vehicle loan, you need to do a valuation, isn't it? Right. So likewise, when you're evaluating businesses, you will also have to value the company, right? Because the importance is, well, if you're giving a housing loan, if the house is worth 5 million and your customer wants 20 million loan, you will not give, right? Because the house is only worth, the property is worth only 5 million, you will never give loan worth 20 million. Likewise, if a business comes to you with a proposition to enhance its balance sheet by 5 billion, and to do that, they might come and ask you for a 100 billion loan, you might not do it. Right? So you need to be mindful of the value of business. That's why business valuation is very important. Now, according to Warren Buffett, value is what you pay. Sorry, price is what you pay, value is what you get. Humans buy only when they get more than what they pay. For example, okay, my phone. Right. So this is my phone. Now, if this phone was priced at, let's say, sorry, I'll use another example. This pen, right? The marker. Now, if this marker was priced at 1 million bucks, will I ever buy it? At 1 million bucks, will I buy it? I will not. Why? Because I will think the price is too high. It is not worth 1 million to me. In other words, from my point of view, the value of this pen is not 1 million. It isn't worth that much. Yeah. But if this price, the price of this pen is 10 rupees, then I might buy it. Why? Although it is not worth for me at 1 million, at 10 rupees, I will buy because I need use. I need this. And I will buy it at 10 if I can benefit, if I can get a benefit of 10 or more. Isn't it? Right? If the benefit that I perceive is 10 or more, I will buy. Otherwise, I will not buy this. If the benefit I get is only 5 rupees, I will not spend it on this. Right? So likewise, this bottle of water, right? Let's say I had 10 liters of water today, and someone offers this water bottle to me for a price of 1,000 bucks. Right? After drinking 10 liters of water, I am offered another bottle of water at a price of 1,000 rupees a bottle. I might not buy it. Right? Why? Because I don't need. I have already had enough water for the day. I don't need enough more water at 1,000 bucks. Yeah. But let's say there is a drought. No, not a drop of water in the country. Then all of a sudden, someone comes to me and offers the same bottle. I haven't had a drink, let's say, for 10 days. No water for 10 days. And someone comes to me and offers this bottle of water at a price of 1,000 rupees. Of even 5,000 rupees. All of us will jump and buy. Isn't it? The same bottle of water at one point was not worth 1,000, but later on we might buy it for 5,000. Yeah. So that is all about price and the value. Yeah. Because at 1,000 rupees, it's not worth to us. But during a drought, it's worth more than 5,000 rupees to us. Okay, so the value that we get is not the same as the price. Those are two different things, entirely different things. Meaning you will buy only what you feel is cheap. You will never buy if you don't feel it is cheap. Value investing involves buying securities that appear underpriced. In other words, cheap is also called underpriced, right? By some form of fundamental analysis, which was introduced by Benjamin Graham and David Dodd. Valuation is the process of determining the value of an asset. Right? What is the value of an asset? Steps in undertaking a valuation process, understand the business. Very important thing. This should be the starting point. You should understand the business. Forecast the company's performance. Right? How is the business faring? Forecast in the future what is expected. Select a suitable valuation model. Convert the forecast into a valuation. Intrinsic value. The intrinsic value of an asset refers to the value of an asset estimated by someone who has complete understanding of the characteristics of the asset. And so someone should have a complete understanding of the characteristics of an asset. That's called intrinsic value, like an expert. Like people we call valuers, they have a complete understanding of assets. Market price doesn't always reflect value. Price doesn't always reflect value. Right, so let's see how an asset can become either undervalued, fairly valued, or overvalued. So if the intrinsic value is 10 and the market price is 5, now for example, if the intrinsic value of this pen, let's say, is $100, is 100 rupees, but the pen is priced at 20 rupees in the market. The price of this pen is 20 rupees in the market. You can buy it for 20 rupees, but the intrinsic value given by an expert is 100 rupees. So if it's available for 20, you should close your eyes and buy because it is underpriced. Then if it is priced also at 100, intrinsic value is also 100, then you can buy. Maybe you may not buy. You may buy, you may not buy. That, right? So it's called fairly valued. But if the price is, if the intrinsic value is 100 and if this is priced at 100,000, you will not buy because it is overvalued. Right? So there are three concepts: undervalued, fairly valued, and overvalued. So overvalued means the intrinsic value should be less than the market price. Undervalued means the intrinsic value should be more than the market price. You will buy assets only which are undervalued. Shall we try this question? What is your answer? An analyst using a number of models and range of inputs estimates the security's value to be $250. The security is trading at $260. Right, so the intrinsic value is 250 and the security is trading at 260. The price is 260. So it is what? Yeah, the intrinsic value is 250. Price is 260. So it is overvalued, right? Because the price is more than the intrinsic value. Any questions? Yeah, it is overvalued. Good. Valuation models. There are two valuation models, absolute valuation and relative valuation models. Okay, let's start off with absolute valuation models. It's about estimating intrinsic value using an asset's own investment characteristics. So the investment intrinsic value is the present value of future cash flows of security. Okay, so the intrinsic value is nothing but the future cash flows, the present value of all future cash flows of the security. It can be divided as discounted cash flow models and asset-based models. Two ways of doing it, of calculating intrinsic value: discounted cash flow model, asset-based model. Estimating intrinsic value of the asset in relation to the value of other comparable assets. That's under relative valuation. The intrinsic value will be equal to the value of a similar asset. Right. So let's get into this later. We'll be looking at price to earnings ratio, the price to book value ratio, multiplier models. Discounted cash flow model. Is based on the logic that individuals make investments because they expect a rate of return over the investment period, right? So you would invest obviously in a land because you expect the price to go up. So value of the investment today should be equal to the present value of the expected future benefits, right? So what it is worth today should be equal to the present value of future benefits. What is the expected future benefit of buying and holding a common share? How would you benefit by investing in shares? Through dividends and capital gains. Right? So dividend discount model, using dividends, you can calculate the intrinsic value of a security, of an asset or a share. The benefits you get are the dividends. So assuming businesses will continue for an indefinite period in the future, the intrinsic value is expected, present value of expected future dividends. Right? Calculated using this formula, it's the total dividends divided by 1 plus the discount rate into the power t. One period dividend discount model. If an investor buys and holds a share for 1 year, the intrinsic value is the present value of the two cash flows, which is the expected dividends plus the selling price of an asset in 1 year. Right? So you're basically discounting dividends plus the selling price, and the discount rate is 1 plus the rate of return. Okay. So let's try this example, then it will be very clear. This the question is based on one period dividend discount model. Apple shares are expected to pay a dividend at the end of the year, $5. The analyst estimates the required rate of return to be 10% and expected price at the end of the year to be $450. Current price is $400. You have to calculate the value of the shares today and determine whether Apple is overvalued, undervalued, or properly valued. What do you all think? Dividend $5. Required rate of return is 10%. Price at the end of the year is $450. Current price is 400. Calculate the value of the share today. That's the intrinsic value. Now, if you look at this, you see them paying a dividend of 5 in 1 year, then the price going up to $450 in 1 year. Right? Your expected return is 10%. Okay. So if you look at this, you will see values coming 1 year from today. You'll also see a required rate of return. Right? So the concept you should use is time value of money. Meaning after 1 year, you get a total of 455. It's D1 plus the price over 1 plus R. The formula that you did earlier. This one. Five plus 450 divided by 1 plus 10%. $413.64. So the intrinsic value is $413.64. Current price is $400. What do you think? Is it undervalued, overvalued, or fairly valued? What are your thoughts? Is Apple undervalued? Is it overvalued, or is it fairly valued? It is undervalued. Yeah, Apple is undervalued, right? Because the price is 400, but the actual intrinsic value is 413. So it's undervalued. If it's undervalued, you need to sell it. Yeah. If it's undervalued, you have to sell it. Then the 2-period dividend discount model. That means you hold on for 2 years. If an investor buys and holds a share for 2 years, the intrinsic value is an extension of what we just did. The dividend that you receive in the first year, plus the dividend that you receive in the second year, and the selling price at the end of the second year. Right. So let's try this example. Apple shares are expected to pay a dividend at the end of year 1 and year 2. $5 and $10. The analyst estimates the required rate of return to be 10% and expected price at the end of year 1 and 2 to be 415, year 2 425. Current price is 400. You are asked to calculate the value of the shares today and determine whether Apple is overvalued, undervalued, or properly valued. Right. So let's do scenario 1. Let's say you're going to sell after 1 year. What happens? Selling after 1 year, the intrinsic value P1 plus P1 divided by 1 plus R. Dividend 5, price 415 divided by 1 plus 10%. 420 divided by 1.1. $3.81 82. And scenario 2. Sell after 2 years. So intrinsic value will be right. Okay. Because you are not selling in year 1. So the only cash flow you will receive in year 1 is D1, the first year dividend. Second year you get dividends of 10 and you're selling at 425. So meaning you will receive a total of 435 in the second year. Right? The present value of first year's cash flow is 5 divided by 1 plus 10%. Second year's cash flow is 10 plus 425 divided by 1 plus 10% squared. This is 4.55 plus 359.5. Okay, 64.05. Am I right? Is this what all of you get? Do we all get these answers? All right. So what do you think? Is Apple undervalued or overvalued? In both years? Current price is 400. Current price is 400. Either way, it is overvalued. Yes, you're right. Any questions up to now? Then Gordon's constant growth model, right? So this Gordon, it assumes that dividends increase at a constant rate indefinitely, right? So assuming every year the company declares dividends and the dividend amount keeps increasing every year at a given percentage. And for example, every year, if a company declares a dividend of 1 this year, next year it might grow by 10%. The year after, another 10% increase. It's every year 10% increase. So something like that. That means the growth rate in that case is 10%. So if that is the case, the intrinsic value is given by this equation, which is an equation you need to remember. Gordon's dividend growth model. Remember this equation. It assumes that dividends increase at a constant growth rate indefinitely. Intrinsic value is the present value of increasing dividends, D0 into 1 plus G divided by R minus G, right? So D0 times 1 plus G. Today's dividend into 1 plus the growth rate gives you next year's dividend, divided by the required rate of return minus dividend growth rate. Okay, so let's try this example. Apple recently paid a dividend of 180, and analysts examine the financial statements and historical dividend policy of Apple and expects that the firm's dividend rate will grow at a constant 3.5% indefinitely. The analyst also determines that the required rate of return on investment is 10%. He wants to calculate the current value of Apple. Apple has recently paid a dividend of 1.8. Dividend will grow at the rate of 10%. Sorry, at a constant rate of 3.5%. And the required rate of return is 10%. He has to calculate the intrinsic value. 28.66. Yeah. Okay, so any questions on that? No questions. Okay. Okay, so the next area is on relative valuation models called multiplier models. Right. Now, since we are almost out of time, what we can do is we can continue this next week. So do you all have any questions from what we did today? Any questions? Well, you need, no, everything that we discussed today is based on cash flow discounting. So you need to be familiar with cash flow discounting. If you understood cash flow discounting, this is a piece of cake, very simple. Also, you need to remember Gordon's dividend discount model. Right? So once you get the cash flow discounting in place, it's a matter of fitting all the dividends in order and then discounting each and every cash flow. Right? You add them up, you get the price, the intrinsic value of a particular share. You need to memorize Gordon's dividend discount model and learn its application. Right? Okay. So any further questions? Okay. So if no further questions, we can wind up for today. And some of you, I understand, are taking your exams next week. So all the very best for your exam. Just make sure if you are doing financial management that I don't see you again next week. Should be the last time you do financial management. Don't ever come for financial management again. If you're taking the exam this time. Next Saturday, I think. Okay, thanks guys. All the best. Stay safe.